Hello, my friends. I'd like to welcome you to our month in review, month in preview video. My name is Brett Pattison with IGGA Global Advisors, coming at you from the financial capital of the West, that is Salt Lake City, Utah. Today, we're going to put the fork in October by taking a look at what transpired during the month of October. We will then look forward to November, and we will ask the question, will we be thankful for November? Now, let's go ahead and get started by taking a look at October. And the best way to gain an idea of what transpired in the month of October is simply by looking at a roller coaster, because a roller coaster month was exactly what October was. For those that keep your eye on the market, you'll know exactly what I'm talking about. For those that maybe don't follow the market as closely, I'm going to share with you what transpired in the month of October and talk about how we reacted to it. Let me share with you a chart. On your screen, you're looking at the S&P 500 index, which is the large cap U.S. stocks. It's viewed as the one of the better gauges for the market as a whole, which is why we're looking at it. But I'm looking at a 9-month chart, as you can see here, and I want to zoom in for the last couple months that we see here. We've got September and October, and the volatility, or the roller coaster ride, really started to occur around mid-September. We went from mid-September, we traded at a high in the S&P right around 2020, and we pulled back through the month of October right around 9.8%. Just round it and call it 10%. So we had a 10% pullback in the market. Now, looking back, that may not sound like a huge deal, right? But the fact is, a 10% pullback hasn't occurred in the market for several years. And in fact, I'm going to point out one day in particular, as September ended, and as October, we got towards the middle of October, around October 15th, when things started to get really nervous for a lot of people. In fact, if you're watching any financial media or reading any financial websites, very, very bearish was what they were pointing out. Now, if I look at a 60-day, 60-minute chart, I'm going to zoom in on October 15th. And as I look at October 15th, right here was the start of the day. You can see we gapped down from the day before, so the day didn't start out right. We had already been pulling back in the market quite a bit. And throughout the day, at least in the morning, we started just to float lower and lower. At one point, the Dow Jones, so not the S&P, but the Dow Jones was down nearly 500 points. The S&P was down right around 50 points, which is a large move on a given day. Now, that was an interesting time of the day. We at IGGA Global Advisors actually sent emails to our clients on that day, on that morning, telling them that we had our eye on the market and kind of told them what we were looking to do or to not do, frankly. And then right when we sent that email, it's actually kind of funny, the market then began to rebound. And you can see since that day, October 15th, really since that morning, right around, right before lunchtime, in fact, the market started to rally and started to go higher. So you started the month of October very bearish. We had a pullback and then ended on a very bullish note. Now, we don't get caught up, and the reason I'm bringing up a 60-day, 60-minute chart is not to get you caught up in the intraday movement of the market. It's just to state and to show some of the volatility or the roller coaster ride that did occur. So I'm going to go back to a six-month chart. I'm going to point out a few more things regarding October. We started October on a down day. We went down through the 15th, and then we rallied higher. One day in particular, October 29th was a key day in the market as far as October goes. That was the day quantitative easing for the Fed ended. And a lot of people thought that the market would see more volatility because the QE, the Fed put an end to QE. Well, how did the market respond? It flew higher, and now we're trading at all-time highs on the S&P 500 and on the Dow Jones, industrials average. So the response was encouraging for the market as far as how it viewed QE, and a lot of people anticipated that, and certainly it did happen. We ended the month in a very bullish note, but there was a lot of nervousness, and there still is a lot of nervousness about the market. So I'd like to point out a couple things as we look at this chart and as we reviewed this chart. A couple other things that for the month of October, and that is, I remember on October 15th, one thing that I sent out that I think is an important principle. This was via Twitter. It's in the middle of the day. You can see 11:57 a.m., October 15th. I made this comment. Not that this is advice in any way, but I've made the comment of don't make a move in your portfolio if you're scared. Make good tactical decisions for the right reason. Volatility is not a bad thing. And that was what, in essence, we told clients through email. I hope those of you listening to this market review didn't let the volatility of the market impact decisions that now you're regretting. So very important principle was taught. So as we look at October, let's answer this simple question. So where are we? I want to point out one of my favorite investors of all time was John Templeton, Sir John Templeton, and he has a quote that I love and that you will probably hear more than once. And that quote is very simple. He says, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I love that quote. It's so true. You can study the history of the markets and learn how true this quote is. But pessimism, think about how the bull market was born. We're over 5 years of a bull market. Pessimism, 2009, right? Tons of pessimism. It's been growing on skepticism, especially with the Fed and what the Fed has been doing. It's maturing on optimism. And I think that's where we are now. People are optimistic, but there's still maybe some skepticism around. So I think maybe more optimism than skepticism. But I think that's where we are now. And when you talk about euphoria is innings 7, 8, 9 of a bull market. And I think that's where we're headed now. I don't know when it will end, but I know that we're still in the midst of a great bull market. And that's how we view the markets right now. And we'll talk a little bit more about that here in just a second. But let's put a recap on October. Here's the global markets. We are a global, as our name states, Iron Gate Global Advisors. We look at the global markets, and I have 3 global markets here. We've got the U.S., which is the S&P 500. We've got developed non-U.S., which would be Europe and Asia. And then we've got the emerging markets, which is India, China, South Korea, and those other countries. So the October percent returns for the S&P 500, we finished the month at 3.76% to the upside. The developed non-U.S. 0.93 and the emerging 3.54. Certainly the U.S. led the way for October. And frankly, as we look on the right-hand side, has been leading the market year to date as well at 10.24. The developed non-U.S. is struggling for the year, made some progress, if you want to call it that, really flat in October, is down for the year, and that's mainly Europe. Europe has been getting crushed. Japan has really been holding up the developed non-U.S. markets. The emerging markets continue to do decent. October was great. India's been flat out phenomenal in the emerging market world, and that's really what has been leading the charge as far as the emerging markets go. But that's the October recap as far as the global markets go. Here's an October recap as far as the sectors go. A couple sectors that I'll highlight quickly, and that is, one is utilities. A killer month in October, 7.42%, and that has a lot to do with interest rates, which fell in October. Utilities received kind of a kick in the pants because of that. Also, healthcare has been lights out, as it has been all year long. You can also see that October, as we anticipated, was more of a defensive month. We have defensive sectors, utilities and healthcare leading the way. You also had consumer staples, which had a good month. So October was really a defensive, kind of a defensive sector-based month, as anticipated. Now let's take a look at year-to-date returns. Healthcare, again, has been leading the way. Technology has been doing very well as consumer staples. So that's where we find ourselves. I don't think it's a surprise that healthcare and consumer staples have been doing so well, just because of the history of the time that we've gone through, that May through October timeframe. Which is typically great for defensive sectors. But I'll tell you, technology has been doing well. We'll continue to be overweight those areas of the market which we think will outperform, and we'll continue to be underweight those areas of the market which we believe will underperform. So there's October in a nutshell. So stick the fork in October. Let's now look at November, and I'm very excited for the month of November. And I'm very excited for a couple reasons. And I'm going to bring up this image. And this is courtesy of Yardani, if I'm saying that correctly, who they got it from Standard & Poor's and Haver. So that's where this chart comes from. But a couple things and basically what this chart is the average percent change each month on average from 1928 to 2014. Okay, so that's what we're looking at. And I'm going to look at the month of November, which you can see is highlighted there. On average, November is an up month for the market, right? 0.6% if you're talking about the S&P 500. So just based on probabilities, we firmly believe that we need to be probability investors, not possibility investors. And so if we're looking at probabilities, we can say, okay, well, on average, the market's up 0.6%. So hey, we like those odds and those probabilities. So we're expecting a bullish month. We could be wrong, but just based upon history, we like where we're going. But here's what I like November for, is November really kicks off the best 3-month run historically in the market. If you look at December averages 1.5%. And then you look at January, you average 1.2%. And so November, December, January, a great time of the year. It's almost a risk-on environment, if you will, to where people are optimistic, the holidays, consumer spending. I'm looking at gas prices coming down and expecting maybe even more consumer spending than normal. But typically, November, December, January, great time of the year. And so we look at November, I again, would expect a bullish month in November. Could be wrong, but that's what the probabilities are telling us. And now I look at this, speaking of November, December, January being that great 3-month bull run. I want to throw some other historical stats at you, courtesy of S&P Capital. And that is November through April typically is the best 6 months of the year. And if you look at this chart in front of you, you can see all the sectors on the left-hand side, but then at the very bottom, you can see the S&P 500. And so you can compare these sector returns versus the S&P 500. And a couple things I want to point out for November through April, and that is industrials, consumer discretionary. Those two sectors do very, very well November through April. Consumer discretionary are those those things that you don't necessarily need, but you want, right? Discretionary spending, industrials. So when we say we're going to overweight those areas of the market which we feel are going to outperform, that's the kind of information we're looking at, right? Now, I'm not saying go and overweight consumer discretionary yourself or industrials yourself. There's a little bit more to it than that. But as we look at these historical numbers, that's where the probabilities are pointing us, right? And so November historically looks very, very bullish. December even more so, January even more so. So when we say will we be thankful for November as far as the market goes, probabilities are telling us yes. We could be wrong, but the probabilities are telling us yes. So that's what you can expect for November. We will continue to scour the entire globe looking for investments that are trading at a good value, looking for those areas of the market that are hot that we should overweight. And really, while at the same time for our clients, looking at risk and not taking unnecessary risk. With that, if you have any questions, feel free to send me an email. You can reach me at brett@igga.com. I want to thank you for listening in today. And again, thank those clients for putting your trust in Iron Gate Global Advisors. Until next month, my friends, we will talk to you later. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.